Not 1 million, not 1 billion. That's not a typo. Not a wrong pronunciation. It is 1,000 billion US dollars. In the first 11 months of 2025 alone, China's trade surplus, meaning exports minus imports, crossed the $1 trillion mark. Not over a decade. Not over several years. Just in less than 11 months. No country in modern economic history has ever done that before. Even in the long river of human history, China is the first nation to hit that target. Hi everyone, welcome back to Difference Frames the World, a channel to see the world from a unique perspective. Today, Clara would like to probe into the $1 trillion trade surplus. On the surface, it sounds like a simple story: China exported a lot, imported less, end of discussion. But once we scratch beneath the headline, this number opens up a much deeper conversation about global demand, supply chains, geopolitics, domestic economic pressures, and where the world economy might be headed next. So today, let's slow down and unpack it rather than reach a quick conclusion. What drove this massive surplus? Why did it happen now? Who benefits and who doesn't? Is this good news for China in the long run? $1 trillion sounds impressive or shocking, but the reality is, it isn't very easy. Let's ground ourselves in the basics first. By late November 2025, China's total goods trade, exports plus imports, came in just under $6 trillion US dollars. Out of that number, exports were roughly $3.4 trillion, and imports were about $2.3 trillion. That gap between the two is the trade surplus, which stood at roughly $1.1 trillion US dollars in the first 11 months of 2025. What's especially striking here is the imbalance in momentum. Exports continued to grow steadily throughout the year, nothing explosive, nothing dramatic, just consistent, reliable growth month after month. Imports, on the other hand, barely moved. In some months, they grew slightly. In others, they even declined a little bit. And when we put those two trends together, rising exports and sluggish imports, we get a surplus that keeps widening. By November, the math was unavoidable. China had crossed a line no economy had crossed before. Here's where things get really interesting. When people hear about China's trade surplus, they often assume it's all about the United States. Containers flooding into American ports, store shelves filled with Chinese goods, the same old story echoes on and on. Donald Trump should impose additional tariffs on Chinese goods. Everything sounds so familiar. But that picture is outdated. In 2025, exports to the US actually fell sharply, in some months by double digits. Trade tensions, tariffs, and political uncertainty weighed heavily on bilateral trade. And yet, China's surplus still exploded. Why can that be? How can China's export flourish without selling more to the US? Because China didn't lose exports but it redirected them. Southeast Asia became China's largest overall trading partner. Trade with ASEAN countries surged as regional supply chains deepened and production networks became more integrated. Europe continued buying Chinese goods at a steady pace, especially machinery, electronics, and green energy products, even as it publicly discussed de-risking. Meanwhile, trade with Belt and Road countries continued to expand, encompassing everything from industrial equipment to consumer electronics. So what unfolds here isn't China exporting more to one place, it's China exporting everywhere. This geographic diversification is one of the biggest structural shifts in global trade right now, and it's a major reason the surplus kept growing even as US demand weakened. Then comes the question: why did China's exports stay strong when global growth was uneven and geopolitics were messy? The short answer is the country's depth in manufacturing. It means China's industrial ecosystem is still incredibly hard to replicate. Let's talk specifics. High-tech manufacturing played a huge role in 2025. Semiconductor-related exports jumped significantly, even as advanced chip restrictions remained in place. China isn't exporting the most cutting-edge chips, but it is exporting massive volumes of mature node components that the global economy still desperately needs. Automobiles were another standout. Chinese car exports, especially electric vehicles, kept climbing as price competitiveness, scale, and improving quality won over buyers in emerging and developed markets alike. Then we've got solar panels, batteries, power equipment, machinery, telecom hardware, among others, the backbone stuff that makes modern economies run. What ties all of this together is China's ability to control almost the entire supply and production chain, from raw materials and components to assembly and logistics. Even if there is demand from the moon or Mars, China can send its products there. That kind of vertical integration means Chinese exporters can adjust prices quickly, shift markets fast, and scale output with fewer bottlenecks than competitors elsewhere. Can the United States make a needle, or a Make America Great Again hat? Of course it can, but with a cost 10 times higher. And in a world that's increasingly uncertain, reliability and affordability count. Now, let us see the other side of the equation. Why did imports stay weak? It is the less glamorous side of the surplus. A big surplus doesn't just mean selling a lot. It also means buying less or not as much as it should. And in 2025, China's imports lagged for several reasons. First, global commodity prices were relatively soft. Oil, iron ore, and other key inputs didn't spike the way they have in previous cycles. So even when China imported similar volumes, the dollar value was lower. Second, domestic demand wasn't roaring. Consumer imports stayed muted. Imports tied to housing and construction remained weak. Big-ticket consumer spending didn't rebound as strongly as policymakers had hoped. In other words, the surplus wasn't driven purely by strength. Rather, it was partly driven by restraint, a weaker domestic demand. That's an important distinction, because it hints at deeper structural questions inside China's economy. Here's where things get uncomfortable. On one hand, China's export engine looks incredibly strong. On the other hand, domestic consumption, especially household spending, still isn't pulling its weight. That isn't a new issue. For decades, China's economy has leaned heavily on investment and exports rather than consumer demand. And while that model delivered astonishing growth, it also created imbalances. In 2025, those imbalances became more visible. That is why the IMF warned China to boost domestic consumption rather than rely solely on exports, as we discussed in a video released several days ago, and viewers who haven't watched it can search our channel for that upload. A massive trade surplus can be a sign of competitiveness, but it can also signal that domestic demand is underperforming. If households were spending more, imports would likely rise. If private consumption were stronger, the surplus might actually shrink. That's why many economists see this trillion-dollar figure as a double-edged sword. It shows how powerful China's production capacity is, but it also highlights how hard it's been to transition to a consumption-driven economy. Chinese policymakers aren't blind to this issue. Throughout late 2025, official messaging increasingly emphasized boosting domestic demand and balancing growth drivers. That includes encouraging income growth to support household spending and strengthening social safety nets. Hence, people feel more comfortable consuming. The government also aims to support small and medium businesses to stabilize employment and expand the service sector, which tends to absorb more labor and rely less on exports. The idea isn't to abandon exports, far from it. It's to make sure the economy isn't too dependent on selling only abroad. Because dependence creates vulnerability, especially in a world where trade can become political overnight. Unsurprisingly, a trillion-dollar surplus didn't go unnoticed. In the United States, it reignited debates about trade imbalances, industrial policy, and tariffs. Critics argue that such a large surplus reflects structural distortions and unfair competition. In Europe, concerns focused on industrial pressure, particularly in sectors like electric vehicles, green energy, and electronics, where Chinese producers are increasingly dominant. Words like overcapacity and dumping popped up more often in political discourse, even as European companies continued importing Chinese goods. Their pockets are flatter than their mouths and tend to be more honest. Meanwhile, reactions in emerging markets were very different. Many developing economies see China not as a threat, but as a crucial trading partner, a buyer of commodities, a supplier of affordable goods, and a source of investment. Same surplus. Very different interpretations. Now, let us address the question, why is China still central? One of the biggest takeaways from 2025 is that despite all the talk of decoupling, China remains deeply embedded in global supply chains. Yes, companies are diversifying production. Yes, China Plus One strategies are real. Southeast Asia has gained manufacturing share. But none of that erased China's central role. Instead, what we're seeing is reconfiguration, not replacement. Parts might be assembled elsewhere, but components still come from China. Final assembly might shift, but upstream capacity remains anchored. That's a big reason why China's export volumes stayed resilient even as trade patterns evolved. Let's be clear and honest, a trade surplus this large comes with risks. It is not always comfortable. Externally, it can fuel political backlash, tariffs, and protectionism. From the collective West, especially. Internally, it can mask weak demand and slow reform momentum. There's also the currency issue. Persistent surpluses tend to put upward pressure on a country's currency, complicating monetary policy, especially when growth isn't evenly balanced. And if global demand slows sharply, reliance on exports can quickly turn from strength to weakness. So while the trillion-dollar figure is impressive, it's not something policymakers want to grow endlessly. As China moves into 2026, a few questions matter more than the headline numbers. Will imports pick up as domestic demand improves? Can services play a bigger role in trade? Will export growth remain diversified or become more contested? How will geopolitics reshape trade relationships? The trillion-dollar surplus is a milestone, but it's also a mirror, reflecting both strength and imbalance. China crossing a $1 trillion trade surplus in just 11 months is, without question, historic. It tells a story of manufacturing scale, supply chain dominance, and global integration that no other economy has achieved at this level. But it also tells a quieter story about domestic demand, economic transition, and the challenges of sustaining growth in a changing world. Whether this surplus becomes a foundation for more balanced development or a symbol of unresolved structural tension will shape not just China's future, but the global economy as well. And that's why this number matters far beyond the spreadsheets.